Two assets, two completely opposite reactions to the same war. Oil exploded to $114 per barrel the morning U.S. and Israeli forces bombed Iran's oil depots in Tehran. Gold, the asset every investor in this room assumed would surge during a war, fell, down more than 5% from its weekly high, down to $5,015 at its session low, while smoke was still rising over the Tehran oil facility. Tonight we explain exactly why that happened, what it tells you about where both markets are heading, and what the professional money is doing right now that most retail investors are completely missing. Good evening, I'm James Harlow. Welcome to The Right Chapter, where we connect the world's biggest headlines to the assets that respond to them. Tonight we have a two-asset episode, because tonight's story cannot be told through one lens. Oil and gold moved in opposite directions during the same geopolitical crisis on the same day, and that divergence is one of the most important market signals you can read right now. Let's take it apart piece by piece. First, the events that set all of this in motion. On the night of Saturday, March 8th, U.S. and Israeli forces conducted what analysts have described as a major escalation of their 10-day campaign against Iran. The targets this time were not military installations or nuclear facilities. They were oil infrastructure. The Tehran oil depot in northwestern Tehran, a massive fuel storage complex serving both the civilian population and the Iranian military, was struck directly. The facility erupted in enormous fireballs that were visible across the city. Satellite imagery showed the entire complex consumed by fire. Black smoke rose thousands of feet into the sky. Acid rain and oily rain fell across Tehran's residential districts. It was the first time since the war began on February 28th that either the United States or Israel had directly targeted Iranian energy infrastructure, and the signal it sent to global oil markets was immediate and unmistakable. By Sunday evening, when global energy markets opened for the week, Brent crude was already climbing past $100 per barrel for the first time since Russia's invasion of Ukraine in 2022. By the early hours of Monday morning, it had reached $119.50, its highest price in nearly 4 years. WTI, the American benchmark, hit $119.48, and in the session that followed, as the full scale of what had happened became clear to traders around the world, Brent settled around $114, still up more than 23% in a single session, the biggest one-day percentage gain in the history of Brent crude futures. To understand why the bombing of oil depots specifically moved the market this dramatically, beyond the already existing Strait of Hormuz crisis, you need to understand what those facilities represent. When you close a waterway, you create a logistics problem. Barrels cannot get from producers to consumers, but the oil itself is still in the ground, still available in principle, and the infrastructure to produce it is intact. When you bomb the storage and refining infrastructure, you are doing something different. You are destroying the physical capacity to handle, process, and distribute fuel, even if the waterway were to reopen tomorrow. You are making the recovery longer, more expensive, and more uncertain. The market understood that distinction immediately, and that is why the bombing of the Tehran oil depots was not just another escalation headline. It was a structural change in the supply picture that oil traders had to price in as a multi-month, not a multi-week, problem. Now layer on top of that the ongoing situation in the Gulf. Iraq's southern oil fields, which produced 4.3 million barrels per day before the war, are now producing 1.3 million, a 70% collapse. Kuwait has cut production because its storage is full. The UAE is managing offshore output carefully. Saudi Arabia began its own cuts on Monday. Qatar's LNG facilities were damaged by Iranian drone attacks. Bahrain's national oil company declared force majeure after its refinery complex was set ablaze by Iranian strikes. Iran's retaliation for the oil depot bombing was to attack energy infrastructure across the entire Gulf region simultaneously. This is no longer a situation where one country's supply is disrupted. This is a situation where the entire Persian Gulf energy ecosystem, representing the single largest concentration of oil and gas production on Earth, is under active attack from multiple directions at the same time. The CBC described it plainly. We are seeing 3 to 4 times as many barrels of oil lost as during the 1973 and 1979 oil crises combined. That is the context. That is the number that should anchor every conversation you have about oil prices for the rest of this month. So how does all of this translate into oil price mechanics? Think of the oil market right now as a bathtub with the faucet running, but the drain partly blocked. The world was actually well supplied before this war began. Inventories were building. OPEC was producing at capacity. U.S. shale was pumping steadily. The bathtub was nearly full. But now the drain, which represents the pipeline of Gulf oil reaching global markets through the Strait of Hormuz, is effectively blocked. At the same time, someone has started removing water from the tub by destroying storage and refining capacity in Tehran and across the Gulf. The tub is emptying from below while the faucet is being turned down. There is no quick fix. The only way the water level recovers is if the drain unblocks, meaning the strait reopens, or if someone adds a new faucet, meaning non-Gulf production ramps up significantly. Neither of those things is happening in the next 30 days. Goldman Sachs has estimated that tanker traffic through the strait has fallen by roughly 90%. Morgan Stanley's data shows that on Sunday, only 2 crude tankers exited the Persian Gulf via the strait, compared to a daily average of 35. JP Morgan estimates that 4 million barrels per day of regional production will need to be curtailed by the end of this week if conditions do not change. Kepler's lead crude analyst has said $150 per barrel is possible by end of March if the strait remains closed. Saudi Aramco's CEO, a man who does not use dramatic language carelessly, described the situation as potentially catastrophic for global energy markets. These are not fringe voices. These are the institutions that manage hundreds of billions of dollars of exposure to these markets, and they are saying the same thing. Now let's talk about gold, because this is where tonight's episode gets genuinely interesting. And I want to make sure you understand this clearly, because the mainstream coverage of gold this week has been largely superficial. Here is the question everyone watching this is asking. Why did gold fall when a war escalated? And here is the honest, complete answer. Gold does not simply go up when there is conflict. Gold goes up when conflict creates a specific set of financial conditions, namely, falling interest rates, a weakening dollar, and a flight to safety that cannot be satisfied by cash or government bonds. Right now, the conflict is creating the opposite of those conditions in one crucial area. Oil at $114 per barrel is an inflationary shock. A massive, sudden increase in energy costs flows through the entire economy. Manufacturing costs, shipping costs, food production costs, consumer energy bills. It feeds directly into the inflation numbers that the Federal Reserve watches most closely. And when inflation rises, the Fed's ability to cut interest rates is constrained. When rate cut expectations fade, the dollar strengthens. And when the dollar strengthens, gold, which is priced in dollars, becomes more expensive for international buyers, and the opportunity cost of holding a non-yielding asset like gold goes up simultaneously. This is the paradox that confuses most investors, and it is worth spending a moment on because understanding it will save you from making a very common mistake. In the early days of the Iran war, February 28th through March 3rd, gold did rise. It climbed as safe haven demand kicked in and investors rotated into precious metals. It reached $5,400 per ounce. But as the oil price surge became more severe and more sustained, the market began to reprice the inflation outlook. The dollar index climbed sharply, bond yields rose, and gold, despite the ongoing war, came under pressure from the very mechanisms that the war itself had set in motion. Spot gold fell as low as $5,015 on Monday morning, down more than 7% from its recent high, even as oil was simultaneously hitting $119. Gold futures settled at $5,103 per ounce. That is the market telling you very clearly that oil-driven inflation is currently a headwind for gold, not a tailwind. The analyst from RJO Futures described it accurately when he said the move lower in gold is driven by a flight to liquidity, a flight to cash. When a shock of this magnitude hits markets, investors who have profitable positions in gold or silver sell those positions to raise cash to cover losses elsewhere, to meet margin calls, or simply because uncertainty of this scale makes holding any volatile asset uncomfortable. The dollar becomes the safe haven of first resort. Gold becomes the safe haven of last resort, the one you hold when you no longer trust the dollar itself. We are not yet at that stage of this crisis, which is why gold is not yet behaving the way it will behave if this conflict becomes a multi-month affair that genuinely threatens dollar confidence. Let's now get specific on price levels for both assets, because precision is what this audience needs. On oil, Brent is currently trading around $87 to $88 after pulling back sharply from Monday's high of $119.50. The key number to watch is $100. We crossed above it on Sunday night and have since fallen back below it following Trump's "war is nearly over" comments. A recross above 100 on sustained daily closes tells you the market is dismissing Trump's de-escalation narrative and repricing the conflict as a prolonged supply disruption. Above $100, Rystad's analysis puts Brent at 110 if current conditions hold for 2 months, and 135 if they persist for 4. On the downside, watch $80. A sustained break below 80 means the market believes the Strait will reopen within days and supply will normalize quickly, a scenario that requires actual evidence of de-escalation, not just presidential phone calls. On gold, spot gold is currently around $5,100 per ounce. The floor that matters most is $5,000 even. This is not just a round number, it is the psychological and technical support level that is held throughout the entire Iran crisis. If gold closes below $5,000 for 2 consecutive sessions, it signals that the dollar and rate pressure story is overwhelming the safe haven story, and the next support is around $4,850. On the upside, the resistance level from the recent failed breakout is 5,400. A close above 5,400, particularly if accompanied by any softening of the dollar or any Federal Reserve language suggesting rate cuts are still on the table despite oil inflation, would tell you the safe haven trade has reasserted itself and the path back toward the all-time high of 5,589 is open again. The CPI data for February releases tomorrow, Wednesday, March 11th. This is the single most important data release of the week for gold specifically. If February inflation comes in higher than expected, which is very plausible given that energy prices were already rising before the war began, it will reinforce the hawkish rate outlook, strengthen the dollar further, and put additional pressure on gold below $5,000. If CPI comes in cooler than expected, it will give the Fed more room to cut rates even amid the oil shock. The dollar may soften, and gold will likely bounce back above 5,200. That data point is your binary trigger for gold this week. Now let's look at what the sophisticated institutional money is doing, because the signals are more nuanced than the headlines suggest. Gold ETF flows have actually been positive during this period, meaning long-term institutional investors have been adding to gold positions even as the spot price fell. The GLD has seen net inflows for multiple consecutive sessions. This tells you that the larger, longer duration money, the pension funds and sovereign wealth funds, is using the pullback to add to gold at lower prices. They are not selling the geopolitical story. They are buying the inflation over time story on dips. That is a meaningful institutional signal that the weakness in gold is being seen as an opportunity rather than a trend reversal. On oil, the picture is different. The CFTC positioning data will be released later this week and will show us how much of the institutional long was added during the spike and how much survived the Trump comment-driven sell-off. The futures curve is telling you something important right now. Near-term contracts are priced much higher than long-dated contracts. That structure is called backwardation, and it tells you the market is pricing in a severe near-term shortage while believing, through the longer-dated contracts, that the situation ultimately resolves. When the professional money is both buying near-term oil contracts at elevated prices and selling longer-dated contracts at much lower prices, it is essentially betting that this crisis is severe but temporary. That is the consensus institutional view as of today. Tomorrow is critical. The US CPI release for February at 8:30 Eastern Time is your first trigger. Hot inflation numbers above expectations will pressure gold and validate the hawkish narrative. Cool numbers will do the opposite. Simultaneously, watch the IEA extraordinary meeting. The International Energy Agency has called an emergency session of its 30-plus member states to discuss a coordinated release of strategic petroleum reserves. If the IEA announces a specific, large, coordinated reserve release, think 1 million barrels per day or more, it will provide the most meaningful downward pressure on oil prices since this crisis began. That action, combined with a cool CPI reading, could shift the market narrative significantly in a single morning session. And we will be here with the full breakdown of both. Tomorrow on this channel we turn our focus to silver, which has its own extraordinary story to tell right now. One that connects directly to the same industrial supply chains being disrupted by this war. Do not miss that one. Oil at $87 today, down from $119 but still up 30% since the war began. Gold at $5,100, falling while oil surges, confusing everyone who expected the safe haven playbook to work in a straight line. The market is not broken. It is being rational. It is telling you that oil-driven inflation is currently more powerful than war-driven safe haven demand. Understanding that distinction and knowing which data point changes it is the entire game right now. I'm James Harlow. This is The Right Chapter. Subscribe, and we will see you tomorrow. Good night.